All right. I'm excited and thrilled to get to do this with you today. This is a chance for me to share what's on my mind live and in real time with you. Again, welcome. If this is your first time, I like to try to do my quick thoughts and reactions with a few ideas bubbling in my mind every week as I'm listening to what's happening in the news, taking it from a not so average counterintuitive financial approach. Again, my name is Mark Willis. I'm a certified financial planner. And this is not your average financial podcast where we're going to dive deep into some of the strategies and systems and stories that can really help you take control of your money in ways that go way beyond just the mainstream, ordinary, basic pablum that you're getting fed from the mainstream, oh so average financial media. So we're going to be talking about and tackling a topic that's been buzzing in the financial circles lately. And honestly, it's one that hits pretty close to home for anyone trying to build and really, truly protect their wealth. The Federal Reserve. That's right. It's time to rethink, reform, or as I'm hearing in the news these days, even abolish the powerhouse institution that's been shaping our economy for over a century. Let's find out if that's true, if it's really happening. I'm going to be drawing some inspiration from some insightful analysis I heard from economist Bob Murphy, who originally explored this in depth on his podcast, what's it called? A Human Action Podcast. But I will be putting it through my lens as a certified financial planner and who's someone who's all about empowering everyday folks with practical financial tools. That's what I'm going to be doing here. It's not just talking high level theory. We're going to connect it down the ladder to your personal finances, including how it ties into strategies like the personal banking strategies like bank on yourself, using dividend paying whole life insurance that I know so many of you swear by for creating a personal banking system that's stable, predictable, and under your control. So if you've been using whole life policies to borrow against the cash value for big purchases or emergencies or investments while you're enjoying tax advantage growth and dividends, this live video is going to be, in this episode, is going to be all about how to help you wean yourself off the banking system and the final boss of the banking video game, the Federal Reserve, how it might be there undermining your stability, and maybe even a particular world, what it would look like without the Federal Reserve. So let me just start here by painting the big picture with even more context, because I think understanding the Fed's role is not just an academic exercise. Getting into the history of this is crucial for just understanding why we're doing what we're doing. The Fed is not some abstract entity floating out in the financial clouds. It's really the central nervous system. It's the central bank, actually, that influences everything from interest rates on your car loan or mortgage to the inflation that's quietly chipping away at your savings account, your retirement fund, or even the cash value in your whole life policy. So for years, we've been told that it's essential for economic stability, having this central bank, preventing panics, keeping employment high. That's what apparently their dual mandate is all about. But has it really lived up to the hype? That's what I want to talk to you about here. And there's some recent comments from Treasury Secretary Scott Bessent. He's been stirring the pot lately. And this conversation even feels more urgent than ever. In fact, just recently, in July of 2025, a post from the official Rapid Response account on X he has a clip of a YouTube video that I found that I want to just bring up to you guys. Let me bring up the screen, see if I can share sound with you too. I'll also share at tabs. Yep, there we go. Okay, share.
Would you just offer up what your opinion would be on firing Jay Powell if the president were to do that? Do you think that would be a good idea, or would you dissuade him from that?
Look, Joe, I think that what we need to do is examine the entire Federal Reserve institution and whether they have been successful. I'm speaking, actually, I'm going to be in the building this evening. There is a regulatory conference that begins tomorrow. I'm the keynote speaker tonight talking about regulation. The Fed as well deals with monetary policy, regulations, financial stability. And again, I think that we should think, has the organization succeeded in its mission? You know, if this were the FAA and we were having this many mistakes, we would go back and look at why has this happened? I mean, look at as you said at the top of at the top of this broadcast, there was fear mongering over tariffs, and thus far we have seen very little, if any, inflation. We've had great inflation numbers. So, I think this idea of them not being able to break out of a certain mindset, all these PhDs over there, I don't know what they do. I don't know what they do.
All right, that's enough of that, I think. That's awesome. What an interesting oh, there we go. All right, great. So, this is the Treasury Secretary, Scott Bessent, essentially saying we need to check out if we're even still doing what we want to be doing with our money, with our central bank system as a country. Now, this is not just some low-ranking Twitter account or something, or a YouTube channel. No, this is the Treasury Secretary of the United States openly questioning the success or failure of the central bank of this country, the most, you might say the biggest, most profitable crony banking cabal in all of human history. Now, and this is Treasury Scott Bessent, right? Treasury Secretary Scott Bessent, who, with his hedge fund background, and now at the Treasury's helm, is now questioning the Fed's bloated bureaucracy. And I love that, the PhD-dominated staff, like the universal basic income for economists, right? This track record on the core missions of price stability and full employment has really got his, he's all focused on this, and he's highlighting how it's become a haven for theoretical economists whose models are missing the real-world impact. And it's leading to persistent inflation, economic bubbles, volatility that hurts everyday savers. This is not just talking heads on CNBC. It's a signal that under the current administration, we might see some real scrutiny, maybe some audits of the Fed, even maybe some reforms, or even maybe an abolishing of the Federal Reserve. So if you're wondering how all this trickles down to your wallet, your investments, or bank on yourself designed policies, stick around. We're going to be unpacking that a little bit with our live time here in our time together today. And I'll be showing and understanding how the Fed could be key to understanding and even safeguarding your financial future, especially if you're in strategies that desire and if you want to emphasize control and predictability in your portfolio. So guys, let's back up just a little bit. Let's go from today's headlines to the beginning. Let's rewind to the Fed's origins with more granularity. I think knowing how it all starts is going to reveal a lot about, and maybe even why some argue it was a flawed institution from the get-go, and how it connects to your trust in the financial system today. The Federal Reserve was officially created in 1913 with the signing of the Federal Reserve Act on December 23rd, just before Christmas Eve. This is when most Americans are not paying attention to the news. They're getting ready for holiday, Christmas preparations, rather than scrutinizing the complex banking legislation. So I just think that's not just accidental. I think it shoved something under the door that the public or the press didn't pay much attention to, and it allowed the bill to pass with a lot less debate. But the real groundwork happened 3 years earlier in this secretive gathering on a little island off of Georgia's coast called Jekyll Island. And it was a secluded spot. I mean, it's a well-known area today, but it's a secluded spot off Georgia's coast for exclusive clubs, maybe the most uber-wealthy club in the world at the time. And in November of 1910, 6 influential men, Senator Nelson Aldrich, who was a Republican leader, economist Fiat Andrew, banker Henry Davidson, he's a JP Morgan partner, Arthur Shelton, and National City Bank President Frank Vanderlip. He was a key Wall Street figure, and German-born financier Paul Warburg. They all met and advocated for an European-style central bank. They met in Jekyll Island, which was a club founded in 1886. It was described in 1904 in a magazine as the richest, most exclusive, most inaccessible club in the world, end quote. So these members like J.P. Morgan and Marshall Field and William Vanderbilt all had mansion-sized houses and cottages there. So these 6 guys, they arrived under the guise of a duck hunting trip. That's what they told everybody. They were traveling separately to New Jersey and then down to Georgia to try to keep everything totally a secret. In fact, they didn't even use their full names. They only used first names, Nelson, Henry, and so forth, to evade any detection by their staff or even the press. I think, again, this is sort of all calling into question, why so much secrecy, right? What was the big deal if it wasn't for their own profit, their own gain? They later called themselves, hammered out a plan, and built a central bank over a 10-day period, drawing on European models like the Bank of England, but tailoring it to America's deep skepticism of concentrated power. Warburg, in particular, said, let's separate it into 12 different branches, or divisions, you might say. He was writing publicly about this at the time. This public distrust of big banks after the panic of 1907. J.P. Morgan personally bailed out the banking system, and it highlighted how reliant we all were on private financiers and moguls. So Aldrich actually and his crew knew that revealing Wall Street insiders and foreign influences crafting this system would ultimately doom it politically. So they needed a secret way to meet and to gather and to build this plan. And so in fact, this meeting on Jekyll Island wasn't even made public until the 1930s, decades after the Fed had been established. So they presented the Fed as a federal reserve system, which is a decentralized 12 regional banks in cities like New York and Chicago, San Francisco, and others. And so they built this system. It was no monolithic bank like the Bank of England or the Bank of France. It was sold as a network to provide elastic currency and preventing panics and stabilizing the banking system without excessive concentration of power. But here's the problem. The regional banks were owned by private member banks who were required to buy stock in the Fed, and they received 6% dividends on profits. So it was sort of a hybrid, a public oversight through DC, a board. The president names the chairman of the board, but private ownership that kind of blurred the lines on day one, giving bankers a lot of influence over the very system that was regulating them. So, if I had my kid regulating the ice cream industry at our house, this would not be a good idea, right? So this setup evolved dramatically. And if you fast forward then to 1935, we're now in the midst, we're neck deep in the Great Depression. And the Banking Act reshaped everything in a way that really centralized the power, made the Fed less accountable, and kind of turned it into the creature it is today. Power consolidated over in Washington, away from the 12 regional banks, and really brought the Board of Governors to DC, and it took a supreme authority. Regional heads were demoted from governors to presidents. That's a downgrade that signaled their subordination to the governors. And the Federal Open Market Committee, the FOMC, was created to unify the monetary decision, to make sure one decision was made as far as interest rates go and that sort of thing. So all this is saying that the Treasury Secretary lost automatic chairmanship. So we're centralizing power at this point. This wasn't the original decentralized pitch of the Federal Reserve or that central bank. It was that crisis of the Great Depression that once again, under the auspices of saving all of us in the midst of a crisis, more power is grabbed, more control is received, and more and more autonomous authority was taken away from the Fed. Now it's underneath the power of the government. So now historians are noting that in 1913, it might not ever have passed. The law of the Federal Reserve, as it currently lives today, would never have been passed as you look back over the beast that was since developed and evolved from 1913. So it was the decentralization was sort of the bait to get it all through Congress, only to switch it on us as economic turmoil began to build and broil during the Great Depression. So this was not just a trivia lesson or history lesson of trivia, right? It's a cautionary tale. It reminds us that strategies like bank on yourself are so appealing in an untrustworthy system, mainly because of the insurance companies' decentralization. There's no federal insurance commission, for example. No, there's not even these insurance companies that I recommend for bank on yourself are mutually owned. They are so decentralized because every member, every policy owner is a co-owner in the insurance company that we have a policy with. This to me is a great relief. I'm able to get a ton more from the safety and security of the insurance company because I'm not the one, I guess, under the thumb of some giant powerful bank No, I've got my own ownership in the insurance company that I co-own with you and everybody else in this insurance company. So if the Fed was birthed in secrecy by elites and morphing during a crisis into something even more insulated, how reliable is the Federal Reserve going to be at protecting our hard-earned dollars? If you think about inflation, for example, pre-Fed under a gold standard or sometimes a silver standard, the Constitution's ratification in the 1700s all the way up through 1913, the dollar was remarkably stable. In fact, from 1793 to 1913, $100 bought roughly the same amount of goods over all these many years of time. Wars like the Civil War may have spiked with greenbacks, which was unbacked paper money during the Civil War. And they also suspended gold convertibility during the Civil War too, but then they restored it in the late 1870s, which led to deflation. And that's a weird word for us today, but think about inflation. We know that word pretty well. Deflation is the opposite. You're actually watching prices come back down, which, in the world of economic growth, this should be natural. We should be naturally seeing deflationary prices across all industries. Think of TVs and computers. Think of anything, like your cell phone. Typically, prices over time will come down. The first cell phones were, tens of thousands of dollars. And actually, I went to an antique museum for old cars during the late 1800s, early 1900s. I don't know, the 1880s to 1930s. There were old antique cars there. The first cars in today's dollars were about $100,000. And then over time, they came all the way down to, in today's dollars, about $10,000 for a brand new Model T Ford, right? So this is deflation at work. And in a normal economy, prices through competition generally come down, not inflate. So prices falling led to what's called the Gilded Age. Gilded means fancy, golden, and in many ways we call it the Gilded Age, the post-war period to World War I, so Civil War to World War I, typically called the best, most productive years of our country. And to me, I think that's something worth paying attention to. We were under a gold standard. We had a solid currency that was not being inflated away. So post-Fed, let's talk about what's gone on since then. The dollar has plummeted. We've lost 99% of our purchasing power. What cost $1 in 1913 would cost over $30 today. And now this is accelerated since leaving the gold standard in 1971. Defenders claim that there's steadier inflation. We have better, price stability. But that's misleading when you look at the longer horizons. Pre-Federal Reserve inflation was basically mean reverting. In high years, it'd go up, but then deflation would bring it back down to stability. So there's up and down years, right? But constant if you look at the mean pre-Fed. Now, post-Federal Reserve, it's more of a random walk. We're seeing inflation basically going up and to the right, and we're never seeing it come back down to the mean of what it should be. It's eroding our predictability. Yeah, I guess you could say I'm predictably losing 2% or 3% a year and due to inflation, but I'd much rather it go up one year and then come down and deflate the next year in order to keep my price stable over a long period of time. So I feel like they've failed the job of price stability. What about maximum employment? Well, speaking of recessions, the Fed's fingerprints are all over those too. And this ties directly into why you might lean on whole life insurance for financial security. The worst U.S. crisis, the Great Depression, unfolded 16 years after the Federal Reserve was launched. So they're totally the ones watching the devastating blow unfold. The 1929 stock crash led to bank runs, 25% unemployment, a decade of stagnation. Milton Friedman blamed the Fed for tight money, letting the money supply shrink. But Bob Murphy and Rothbard and others argued that the Fed fueled the 1920s boom with all this easy credit, setting up the bubble bust in the 1929s and 1930s. So if you contrast the 1920 downturn, where we look at those numbers, unemployment hit 12%, but recovery was swift. It jumped back up again. Without any Federal Reserve intervention, prices adjusted, wages fell, the economy rebounded in just 18 months. Post-Fed, the crises that we go through seem to linger. That 2008 recession saw a housing bubble pop, which of course had been fueled by the Fed and low rates after the tech bubble. And that subprime meltdown, $700 billion later to bank bailouts. Ben Bernanke, who once apologized for the depression, vowing no one will ever go through another deep depression ever again. He oversaw the QE, the quantitative expansion of the money supply that ballooned the balance sheet of the Federal Reserve from $900 billion to $4.5 trillion. You think that's going to have an impact on our dollar? You bet. Having that kind of liquidity sloshing around to buy your loaf of bread or a dozen eggs. And so the recent volatility from 2020's COVID response, they dumped another $5 trillion in. And of course, since then, we've seen inflation really spike, even up to 9% in certain years post-2020. It all shows a certain pattern, a criminal pattern of destroying our money, which, at the end of the day is one of the key things that makes you free, is your capacity to make choices through this thing called money. So back to Scott Bessent's comments that he made recently, I think it builds on the critique. He's amplifying this call for change. And, we talk about it. So he mentioned that he compared the Fed to the FAA. He said if the aviation industry had this many mistakes, we'd overhaul the FAA. And he says the Fed's failure to predict tariff impacts is like, again, pointing to a stuck mindset. He called it universal basic income for academic economists, which I think is hilarious. It's basically just a think tank that influences every decision you make in your life. Do you want a bunch of, calculator type in, glasses pushing nerds up at the Federal Reserve making decisions about how much you need to spend on that house down the street, or sending your kids to college, or paying for your credit card bills, et cetera, et cetera? So as we kind of wrap up, should we abolish the Fed? There's some things that make me say yes there. It's better to see what the country looks like without it. But it would be a big change, right? We were more stable pre-1913 as a country, but we're living in a different world now. But does that mean we need the Federal Reserve? I think that empirically, there's been worse performance. There's been more inflation, certainly. 99% value lost in the dollar. Yuck. More crises. There's been multiple decade crises since 1913, and it does not appear to have lowered the volatility or reduced unemployment. So they failed at their two main jobs, price stability and maximum employment. So if you're asking my opinion, and I guess I'm leaving this up there for the world to see, yes, we should absolutely take on the final boss of the banking video game, because at the end of that story, only you can be the winner. Hope you guys enjoy the rest of your day.